Hi, I'm Mark Jarvis, CEO of Giga Metals. We have a very large nickel and cobalt deposit at an interesting time. The rise of electric vehicles and the demand for nickel is growing at a rate that will require, some say, 40 to 70 new large mines by the year 2040. We are potentially one of those large mines. We recently put out a PEA that models capacity of 37,000 tons per year of nickel with a 37-year mine life. That's a very large mine, and it's similar in size to the giant HPAL projects that are being built currently around the world. We own 100% of it, and we are looking for strategic partners to help us advance this. It's when you've got a very large deposit and you're a very small company, it's very, very challenging to develop the project. And so we're at the point that we're looking for larger partners to help us advance this project. We're in a great jurisdiction, Northern British Columbia and in Canada. So you have to meet high thresholds in terms of environmental studies in order to get a project like this off the ground, but it's doable. Once you do that, any Canadian mine, if you are a consumer that's concerned about the ethical principles of where you're sourcing your raw materials, well, a very good place to start is Canada. So we've got a very large low-grade resource. The concentrate is high grade, and clean. So we've got a concentrate that we can make reliably that's 18% nickel, 1% cobalt, and it's very clean of deleterious elements. This means that we can either sell it to a smelter as a very desirable product to the smelter, or we're looking at the possibility of putting it through a pressure oxidation circuit to make a mixed hydroxide product. And the mixed hydroxide is emerging as the chemical form of nickel and cobalt that the battery makers want. The other thing about our project is that the flow sheet is so simple. This is sulfide minerals. You dig the rock up in an open pit, you crush it, grind it, and use froth flotation to make this concentrate. There's no extra steps such as desliming or magnetic separation. It is a simple flow sheet. It's a reliable flow sheet. That's one of the strengths of this project. We think it could be a carbon neutral mine for scope 1 and 2 emission, because we can sequester CO2 in our tailings. And we've recently received some test work data on this that supports our ambition to be carbon neutral. This is a little bit more about our nickel sulfide concentrate. Our net operating cost to deliver concentrate at the mine gate is $2.81 a pound of nickel over the life of the mine. It's, of course, less than that in the early years. And again, it's all about the concentrate, which compares well with the current operations of people that produce concentrate. We are in the very top tier, where we would be if we were in production like these people are. We have designed a very world-class, tailings facility. It's designed to be safe. We've got a perfect place for the tailings. When you spread around the tailings, which are basically like a silicate sand, and you expose it to the atmosphere, during the process of absorbing CO2 and converting minerals such as brucite to carbonate minerals, and sequestering the CO2 away for geological time periods. As part of that process, the sand goes through a cementation process. So we're designing an extremely safe tailings facility, but the process of cementation will make it safer. In general, sulfide ores such as ours have a much lower carbon footprint than HPAL. And then if you look at taking nickel pig iron and converting it to matte and taking it to battery chemicals or to metal, that's incredibly carbon intensive. So If you're interested in ethically sourcing your nickel, again, you know where to look. And this just shows where we would be on the scale of carbon intensity as compared to other projects worldwide. We put out our PEA, our base case, using a diesel fleet, was that we would be at 2.24 tons of CO2 equivalent per ton of nickel we produce. Now, if you had an electrified haul fleet, which doesn't exist yet, we don't have trucks of the size that we're talking about here. However, we think the market is moving that way. And if you can use an electrified haul fleet, we could reduce our CO2 intensity to 0.69 tons of CO2 equivalent per ton of nickel. And then with the data that we've recently gotten from the University of British Columbia, Dr. Greg Dipple, we are actually to zero. And so the process is you mine the material, you process it, and then, and all of this creates emissions. But then the tailings absorb CO2 from the air and, reduce the emissions to zero. At least that's what the data we've got so far is telling us. So ethical sourcing of nickel, we are engaged with the local First Nations communities. And the standard practice is to, before you build your project, negotiate an impact agreement with the local First Nations. They're very interested in jobs, contracts, that sort of thing. So compared to laterite deposits, this is a hard rock deposit. It's an open pit. It's actually fairly limited surface disturbance for the amount of material that you're moving. A laterite deposit is a strip mine. And a lot of these are located in places like Indonesia, Papua New Guinea, with tropical rainforest. And so you strip mine large areas of biodiverse tropical rainforest to get at the mineralized clays. And there's a lot of erosion to the ocean and to rivers. And in many instances, after processing, the tailings are dumped in the ocean. So again, the point is, if you're looking for ethical sourcing of your battery metals, come talk to us. So low greenhouse gas footprint. The hydroelectric power supply is a very clean source of power, and we do have a pathway to carbon neutral. This is an interesting slide, I find, from an investment perspective. We started with a 40-year chart of nickel, inflated to current 2020 dollars. A couple of interesting things emerged from that. The average price of nickel in current dollars over the last 40 years is $11 a pound. And our PEA sensitivity price ranged from $6 to $11. Our PV8 value at $6 nickel and at $8 nickel is actually negative. But when you look at our market cap of $30 million and you think about what could happen at $10 nickel or $12 nickel, at $12 nickel, our after-tax PV8 is over $1 billion US. The balloon effect, as I call it, of the net present value means that a deposit that we've got, which is marginal at current prices, balloons in value if you assume higher nickel prices. And so if you think nickel prices are going higher and that they have to go higher in order to deliver all of this nickel to the market that's needed, then this is highly leveraged. A deposit like Turnagain and a company like Giga, we are highly leveraged to the nickel price. So it's what you call optionality. And even though we are marginal at today's prices, so are the HPAL projects. And these are the projects that are getting built, oftentimes by the Chinese, who are thinking of things strategically. Our economics are actually superior to even the best of the HPAL projects. So why are they getting built? Well, the Chinese think strategically. They want a long-term supply of nickel, lots of nickel, at prices that they can predict, sort of the equivalent of creating a long-term nickel contract at a fixed price. But the only way you can get that is by building a mine. And the Chinese have realized this. And when the cost of capital is so cheap, and you're dealing with state capitalism where they can simply tell the state-owned banks to loan money at such and such an interest rate to such and such a project that is a strategic project, they don't care about low internal rates of return. What they care about is getting the project off the ground and delivering. It's the operating costs that they care about. HPAL projects are getting built, and I think similarly, projects like ours are going to have to get built to supply Western battery manufacturers. They'll either have to get built by nickel prices going higher or by someone stepping in with a low cost of capital that has a desire for long-term supplies of predictably priced nickel. Again, a very large resource base. Here's our timeline. We are starting a work program this year to gather the data we need to advance the project's engineering to pre-feasibility level. If we had enough money, we could be looking at startup in 2028. So about 8,000 meters of resource drilling and about 2,000 meters of geotechnical drilling are planned this summer. So again, why invest in Giga? Well, if you're interested in ethical supply of nickel, this is a good place to look. The market for lithium-ion batteries for electric vehicles is growing so quickly that you're going to need 40 to 70 new mines of a similar size to Turnagain over the next 20 years. So we're in the right place at the right time, I would say. We've got a deep board, very well connected with the capital markets, so we tend not to run out of money. Martin Vidra, our president, is well known to all the strategics. This is our capitalization. $33 million market cap is pretty cheap. Thank you very much for taking the time.